Alright guys, whole life insurance explained. Term insurance versus whole life insurance. Alright, so we're continuing our series on life insurances right now, and in the last video we talked about term insurance, and today's video we're talking about whole life insurance. And this is the insurance that Dave Ramsey goes on and on about, and he goes about why it's bad, and he never really has anything good to say about it. But what I think is the guy is uneducated. I mean, he's a podcaster and he did real estate, so he doesn't really have the experience. He isn't licensed or anything to really talk about what whole life insurance is. So that's why I'm here to explain what it is, why you should get it and why you shouldn't get it, and what benefits does it has that makes people buy it. Alright, before we jump into whole life insurance policies, please be sure to smash the like button and smash the subscribe button, because that's the only way to get this video pushed out to people who actually need this life insurance to keep themselves and their families protected. So in the last video, we talked about term insurance and term life insurance and when you should really buy it. So if you haven't checked that out yet, then double back and check that out there. Because in it, I don't just cover term insurance. I also cover some mindset work that I think everybody should have that would not only serve you when dealing with a life insurance salesman or just life in general. Because in any facets of life, when you have the proper mindset, then usually you would come out ahead rather than behind. Remember, selling life insurance can be very lucrative to licensed insurance agents depending on what they sell. But depending on what they sell may not always be best for you. They can make a killing because the commissions are nuts, but ultimately it really depends on your mindset, on how you read people. Ask yourself questions to ask yourself, okay, what is the commissions of the product he's selling me, and what does he have that incentivizes him to sell me hard? Questions that I always ask myself when I'm dealing with an agent or someone who is getting paid by commissions are just 3 questions. Is this their primary income? Are they pushing for a certain product? And are they in this for me, or are they in this for themselves? And always trust your gut, because the brain and the gut are actually connected. There is some sort of nerve that actually connects them. So when you get that gut feeling that something is wrong, that's just your gut being your second brain in order to keep you from getting screwed over or keeping you from getting into trouble. Like I said in the term insurance video, the only reason that I would ever get term insurance is for family and under the following circumstances. 1, I just graduated from school, from college, and I just got my first job. Now that job doesn't pay much, but it does cover a basic term insurance policy such that if I die, my beneficiaries, that is my parents, get something out of it. 2, and this is the most important reason, is I just started a new family and I am the main breadwinner. I have 1 or 2 kids under the age of 5 or 10, and if something happens to me, then it'll be all over for them. This is also known as the most vulnerable time for a family. When you have young kids, when you have kids that are small and you don't have a lot of money to cover for unforeseen events, that is when you're putting you and your family at risk. And to kind of tell you a story, this is exactly what happened to one of my high school teachers. It was the last year of my high school, and it was something like September or October, but we were in our class and we were just doing our work, and then up comes the PA, the announcement system, the speaker system, whatever you call them, and they just said that one of our gym teachers did not wake up this morning and that he unfortunately passed away. Now he was in his 40s or something, around that age, but the thing around him is that he was the main breadwinner and he had 2 young kids and a wife to support. And it was a sad thing because he was there ever since I entered high school. When I was a freshman, he was there. He was coaching us all throughout my 4 years in high school, because in Canada we have grade 8, 9, 10, 11, 12. Actually, that's 5 years, so I can't count. But he coached us through that entire 5 years in school, and it's kind of different to really hear this teacher who's been with you for 5 years. You've seen him each year for 5 years, and you suddenly go to school one morning and the PA system tells you that your teacher has passed away, that your gym teacher has passed away. You know, his wife tried to wake him up one morning. He went to sleep the night before. His wife tried to wake him up one morning, tried to shake him awake, just to find that he died in his sleep. And she instantly at that point became a widow with 2 kids. And I don't know if they had life insurance or not, but I doubt it, because what they tried to do is make a fundraiser to really support the family of our gym teacher that died. And if they had a policy, then likely chances are they wouldn't need to do that, because the expenses would have been covered by the life insurance policy. Alright, so let's talk about whole life policy. So whole life is a form of permanent life insurance. The other two forms are variable and universal life insurance, which we'll talk about in 2 separate videos. Or if they're short enough, and my notes are short enough, maybe just one. So with whole life, it is permanent life insurance. That means it stays active until the day you die or until age 100, whichever is sooner. And you can pay for it in 3 ways. 1, you can pay it the single premium way. The single premium is just one big lump sum payment on the policy. The great thing about this is that you have immediate cash value because you overpay the premium. And if you're wondering, why would I just pay one lump sum ever? Keep with me, because it goes into your cash value. That cash value account is your way of avoiding taxes. So stick with me, we're going to talk about that. But the second way is limited pay, which is pay a set number of years or up to a specific age. And most people pick to be completely paid up by the age of 65 when they want to retire. And that is just so you don't have to worry about paying premiums at the retirement age of 65. And as a side note, with how the government is printing money and how they're dealing with this pandemic that we're facing and the fallout, a lot of people, hate to say it, they're not going to retire for their entire lives. But with limited pay, you can't expect your premiums to be higher than the normal way, which is the third way that we're going to talk about, because you're paying a set number of years, or you're paying until 65. Normally you'll pay until you're 100 or until you're dead, whichever is earlier. But if you pay till you're 100, your premiums each month is going to be smaller. But if you're paying till a set number of years or to age 65, you have a shorter time in order to grow your money to the death benefit, which we want. So if your death benefit was $1 million, they want to grow your cash value to $1 million. So that limited pay means that you will have to pay a higher premium. And then the third way is straight life, where you are paying that premium month to month. This is what I do. And you pay that until the day you die or until the age of 100. And the premium for this is going to be smaller than both the lump sum and the limited pay, because you have till the age of 100 to really grow your cash value to whatever your death benefit is, using our example, $1 million. Alright, term insurance versus whole life insurance. Alright, so now you know that the basic difference between term and whole life that they test us licensed insurance agents on is that term insurance is temporary. It is for a specific span of time and it has no cash value. Permanent insurance is until death or age 100. It offers lifetime protection and has cash value. But why is it to age 100? Actually, that is a great question and I've never meant to ask. That is a question that bothers me too. But I assume it's a risk management thing, because most people die around when they're 80 or 90, even with advancing technology. That age 100 might be raised at some point when technology gets so good that everybody lives past 100. But for right now, it is 100. So when you get a life insurance policy, they actually run you through mortality tables. They take the death benefit amount that you want and complicated math equations compared with your health, your lifestyle, your genetics, all those factors into these mortality tables that they use to calculate the premium or how much you have to pay each month. The idea is to get your cash value account, which is a separate account, which is invested into things like the stock markets and things like that, depending on your risk tolerance, so that it makes money passively for you. And they want that cash value to equal your death benefit by the age of 100. Again, if you choose limited pay and you want to finish paying your premiums by the age of 65, then of course your premiums will have to be higher every single month, because they have to make that cash value account equal to your death benefit by 65. And once it is equal to your death benefit, then literally you don't really need your death benefit anymore or your life insurance policy, because if your life insurance policy was $1 million and they grew your cash value to $1 million, then you have the $1 million that you originally asked for when you had $0, for example, to take care of your family, just in case you die, and you won't need that life insurance policy anymore, but you will still keep it. And we'll talk about why in just a moment. The whole idea for a life insurance policy that people don't seem to get is that that policy is for protection before you grow your money to $1 million in that cash value account. After your cash value gets to $1 million, then your family is covered even when you die, because if you die before 100, they get $1 million of death benefit. If you die at 100 or after 100, then they're going to get the $1 million cash value account. The money, death benefit, or cash value, whatever it is, it'll go to your beneficiaries when you die. So again, if you die before the cash value reaches $1 million, the insurance policy pays $1 million in death benefit to your beneficiaries, which is your family. If you made it to 100, if you grew your cash value to $1 million and then you kick the bucket, no worries. Your beneficiaries get your cash value of $1 million. Oh, and this is the thing you want to know about how to avoid tax with that cash value. With that cash value account, and this is the reason why we keep our life insurance policy, is that you can take a loan against it in order to fund your retirement at any time. So say you have just $700,000 in your cash value. You could still take a loan against it to fund your retirement when you want to retire. It just has to stretch out for your entire retirement. And it won't get taxed. And why? Because you're taking out a loan. And when you take out a loan, you don't get taxed on that loan. It's just a loan to yourself. And this is what they mean by being your own banker. That is why we keep our life insurance policy even when our cash value account has reached the level, the same amount as our death benefit. And this is the trick that the rich uses in order to get across taxes, to not pay taxes like we do in our 401ks. Alright, that was pretty simple, right? So that's pretty much it for our whole life insurance. If you want to know more, then please be sure to smash the like button, smash the subscribe button, because I'm creating this series of life insurance videos in order to educate people like you who want to know how insurance works. So other than that, smash a like, smash the subscribe, check out my last video on term insurance, and I'll see you guys next time. Peace.